3, 2, 1.
Here we go!
We're here with Greg. Greg and I were college collegiates. What do you call that? College colleagues. College peers. Yeah, we both went to UCSD together. We were both part of the same investment society called Undergraduate Investment Society. And together we started our Padawan adventure into becoming financial Jedi in the future. Yeah, so Greg, maybe you could start with giving us a little bit about your background.
Sure. Well, first I'd like to give a shout out to UCSD because the UCSD crowd has been holding it down. No joke. Got quite a few alumni holding it down in crypto space.
That's right.
But basically, my background, I've been trading for about 12 years now, like obsessed with learning about options and derivatives, and got into the crypto scene. First learned about the crypto scene in about late 2011, early 2012, and then first invested in crypto in about 2013. But basically, my background was as a trader. I studied economics and accounting at UCSD. I was part of the finance club. Me and Will Warren actually started a prop trading club, which was very fun, and then did some research into the crypto space for a senior paper. And that's how I first sort of learned about it. Went on the dark web. Actually co-authored that with Linda and used her computer to go on the dark web because that was not something I want to do on my computer.
This is Linda Xie for reference. And Linda is now a VC in the crypto space on Scalar Capital. So maybe we'll talk to her in the next episode. We were peers together, and so Linda actually told me the story about how she went on the dark web. So I didn't know that it was with you when she talked about that.
It was weird. It was super weird. And actually, my conclusion was, holy smoke, this is like really scary. I don't know if I want to own Bitcoin. So I don't know if I want to be part of like this kind of sinister dark web experience.
I mean, what did you see?
Just murder for hire. That was like kind of freaky. Yeah.
Okay,
like so drugs or anything. It was like real serious
murder
stuff.
for hire. All right. Now that we're on that topic, were you able to gain some sort of perspective about Dread Pirate Robert's story?
Nothing much beyond like watching a Netflix video about
so
it.
You saw stuff like murder for hire, and was this on the Silk Road, or where was this?
So there's like a dark web Wikipedia, because it's like there's no like Google where you can like find the links that you're looking for. So you have to like cross-reference sort of like this index and call it like the dark web Wikipedia that has all the different sites that you can go to. And that way you can like use those URLs directly to go to the sites that you want to go. And that kind of had like a menu of all the things that you can look for. And so on that menu, there's like some typical stuff you would expect, but then there was sort of like this crazy gnarly stuff like murder for hire.
Whoa, that's really scary.
It's about $10,000 for those who are wondering what the price was.
That is lower than what I would have expected for something like that.
Right.
So are those movies that we watch where, there's like Nick Cage or whatever actor playing a hitman? Is that true?
Yeah, I don't know much beyond that. I know that I saw that and I was like, all right, I don't know about this.
Okay.
But years later, so just to kind of circle up the loose ends. So after UCSD, I went to Chicago to start a prop trading career. I was at Chopper Trading, where I met some folks that I'm still very much in touch with, trading treasuries, U.S. Treasury futures versus U.S. Treasury cash. We later got bought by DRW, spent some time working at DRW for a while. And then in about 2015, I left and started trading my own book. So I started trading my own book and sort of investing in real estate on the side, and then basically holding sort of my crypto. So I'd bought some Bitcoin in 2013, and then discovered Ethereum along with a couple other folks, and pretty much transferred from Bitcoin to Ethereum. So sorry for all the Bitcoin maxis out there. I'm more of like an Ethereum person myself.
Don't worry, we don't have Bitcoin maxis listening to this channel anyway.
And so basically started really working in the space of Ethereum. Started working my book in the crypto space as well as like a traditional finance book, and then in 2019, I have a friend who I met in Chicago throughout the years, and I kind of got him into crypto. And ever since he learned about crypto in about 2016, he's really been into it. And he is now my business partner. He was working at a on-chain data analytics company that would basically look at on-chain data to create trading signals. And this was all on the Ethereum blockchain. And so basically he asked me to come do some consulting work for that company because they didn't have any traders. They just had a bunch of data scientists. So I kind of decided to do some consulting work on the side for them. And that's basically how me and my business partner first started working together. And then after working there for a little while, we left and started Genesis Volatility. And Genesis Volatility is basically derivatives on crypto. So it's crypto options analytics, kind of looking at the options market for sort of the most volatile asset class. For me, that was the perfect combination of my passions. And really my main passion throughout my early career has been options.
Yeah, that's amazing. And it sounds like you guys have done really well for yourself since you've started in the early days. And then it sounds like you've diversified, right? You have crypto holdings, you also did treasuries trading, and now you have like a volatility platform. Tell us a little bit more about that. How are your earnings, right? I mean, people watching this channel are going to want to know how they could grow their own wealth. And so what was sort of your strategy? And maybe you could illuminate how you grew your wealth.
Yeah, definitely. So there's kind of a couple things. So from the cryptocurrency side, I have sort of a trading book, and I also have like a long-term investment sort of holding as well. So I like to separate those two and keep those separate. I want my tradings to be trades, and I want my investments to be like sit and wait and hold type things, and not confuse the two of them. And then
is there a percentage of money that you're willing to trade and keep liquid, whereas like a percentage, there's a percentage of your money that you're keeping illiquid as investment?
Yeah, so that's a really good question. So I kind of do 60-40, 60% long-term holdings. But what I do is that like when a market rallies, I end up like rebalancing. So over time, like you could just think of like a trading account kind of like as a cash account. And then the investment, as crypto does well, I kind of rebalance into that. And then if crypto does really poorly, I'll sort of rebalance. I'll buy more crypto when we have bear markets and sort of rebalance that way as well.
Okay, so it sounds like you have 40% in crypto, and that's your liquid account, and 60% in other things like.
Oh, sorry, maybe that was unclear. It's like within my crypto world, I would say 40% of my crypto book is a trading book. 60% of my crypto book is sort of an investment.
I see. And what percentage of your entire, I guess, portfolio is your crypto book?
Let me think here. Probably like 65%-ish.
And you're doing options on both, right? I assume the other is stocks and treasuries and.
Yeah, actually, I've stepped away a lot from traditional markets because I think that there's a lot less edge than there is in the crypto markets. So in sort of like my non-crypto, I mostly just own real estate.
Real estate, got it. Okay, so we won't be talking about that in in this episode. But yeah, okay, let's talk about like crypto options trading, right? So my foray into options was actually through observing the Wall Street Bets crowd. And so I would have never actually gotten interested in that were it not for Wall Street Bets. Were you a part of that game, or were you just kind of watching from the sidelines?
No, you know what? I barely looked at Wall Street Bets. It's not something I pay a lot of attention to, but it's something that I do find interesting. I'm like so happy to see a lot of people learn about options, get into options, sort of cut their teeth around like structuring different positions using options. That's something I'm really excited about, and I think it's a super like versatile and useful investment tool for people to sort of capture the exact like nuanced bias that they have. So, you know, when you're trading like a Delta One product or like spot market, you're basically buying because you think it's going to go up, or you're selling because you think it's going to go down. With options, you can tailor your opinion to like capture a specific opinion. So what I mean by that is like, let's say that I think that crypto is going to do nothing for a while. Well, there's volatility strategies where I can basically bet that crypto is not going to move around for the next 1 month. Or I think that for example, right now, Bitcoin's at 52,000. Let's say I think that it's not really going to get above 100, but I also think it's going to go up above 60. Well, I can sort of structure a trade that captures profitability between 60 and 100 and starts giving back profits above 100 or below 60. So you can kind of structure very nuanced opinions, investment opinions.
Really? Okay. So let's talk more about that. Our listeners are going to want to know exactly how to capitalize on that. And so what sorts of platforms would you use to do that? And what are the mechanics? So let's go with like platforms first.
Sure. Yeah, that's a great opening question. So there's kind of like there's three tiers of potential clients. So the first crowd is sort of the non-US crowd. So for the non-US crowd, some of the exchanges that I like a lot are bit.com, Deribit, OKEX, delta.exchange. Those are some of like the overseas exchanges that people can trade options on. For the US crowd, it's a little bit more limited, but it's growing. So we have CME for kind of the bigger traders. You have CME Bitcoin future options and hopefully Ethereum future options soon. And then you have, for the smaller traders, there's Ledger X, which is a regulated exchange here in the US that trades crypto options, where you can trade some smaller sizes. And then lastly, for the DeFi crowd, there's a lot of interesting DeFi venues. So Hedgic is a very interesting venue. Hedgic, basically buying options. It's kind of familiar to anyone who's traded options, but selling options is sort of like a pool type of situation. So you lock up some ETH and basically you end up being the counterparty to anyone who's buying options against the pool. There's Open, which is another DeFi option protocol. That's kind of a traditional limit order book. And they've just actually released their version 2 where you can sort of spread options. So you can do call spreads, put spreads, stuff like that. There is Pods, there is Hedgit. Those are some of the other DeFi option venues. And there's actually quite a few coming online as well. So you have a lot of platforms to trade crypto options.
And which one do you use and recommend?
The ones I recommend are overseas, Deribit, bit.com.
Those are the centralized exchanges, right?
Correct. Yeah, these are the CeFi exchanges. Something that I've been trading on is just the CME Bitcoin options, Bitcoin future options, and then pretty much the ones I recommend, Ledger X as well here in the US. And then for execution, we recommend Paradigm. So Paradigm basically is a RFQ system. So there's about, I think.
Sorry, and what is an RFQ system?
Yeah, sorry, good question. Jumped a couple steps. So RFQ is a request for quote. So if you want to trade a multi-legged spread, call it like a butterfly or condor or something that has 4 contracts to it. Basically, you say, I'm looking to trade this spread, and you request a quote. And I forget how many market makers are on that platform, but more than 30. And there's about, let's call it 30 market makers. So you say, I want to trade this spread with these contracts in this expiration date. And you request for a quote. And then all these market makers will come back at you with a two-way market. And they'll say, if you want to buy it, we'll sell it to you at this price. If you want to sell it, we'll buy it from you at this price. And that way you can sort of get seamless, simultaneous execution with like very good, like in between the bid and the ask sort of prices. Going
back to before I interrupted you about the RFQ question. So now CME futures, right? So what do you actually do when you're trading Bitcoin options?
Yeah, so some of the spreads that I like a lot are butterflies, broken butterflies, 1x2s.
And what are those?
Yeah, so for those who don't know what those are, so basically butterflies are sort of like, I guess I'll kind of explain it to you with strikes. So let's say right now Bitcoin's at 50,000. A butterfly would be like a $50,000 call, sell 2 $60,000 calls, and then buy 1 $70,000 call. So what you do there is that you have sort of like this window of profitability between 50 and 70 minus the cost of the trade. And so the reason why those are interesting is because when you're trading options from a volatility perspective, you're sort of like, something like that isolates a big component of the volatility. And from like a cost perspective, it finances those 2 60s that you sold help finance the 50, and then you buy that 70 to cover your tail risk of the 2 60s that you sold. So it's like a type of trade that allows you to take advantage of volatility, allows you to bet on time decay, things like that. And then broken butterfly is just a variation of that, where instead of buying the 70, you buy the 80 on that tail. And then the 1x2 would be like you buy the 50 call and you sell 2 $60,000 calls.
maybe we should back up and talk about how options work in the first place.
Sure.
Right? Because you're saying it sounds like there's two sells and two buys, making it into like a sort of butterfly structure.
Yeah, exactly.
Yeah, like what's the kind of money that you need to put in initially in order to get these calls and puts? How do you actually, place these orders?
The type of money you need to trade options, that's one of the benefits to options, is to sort of inherent leverage in these sorts of vehicles. So you can open an options account with $2,000 and kind of just start there. The CME future options are a little bit bigger. They're 5 Bitcoins per contract. But even in that
is that the minimum that you need to put in?
Yeah, unfortunately, CME Bitcoin options trade in 5 lots. Ledger X will trade in 1/100th of a Bitcoin, and then sort of those overseas exchanges will trade in 1/10th of a Bitcoin.
So the CME game is more of a whale game. Is that it?
Yeah. Yes and no. It's a bigger contract, but even though it's a bigger contract, something like a butterfly, you can put on a butterfly position for a few grand. It doesn't have to be like a $10,000 bet or anything like that. So depending on your option structures, you can still position some stuff. But I would definitely start with one of the smaller exchanges if you're a smaller trader, because it allows you the flexibility to sort of piecemeal into and out of your trades.
And what about Robinhood? Is that platform useful for this, or do you?
It's not useful for this, no, unfortunately. I've never used Robinhood. I don't really have an opinion on Robinhood.
Gotcha. Okay. Just thought I'd ask because, lots of Wall Street bettors are using Robinhood.
Yes,
maybe not
right.
anymore. Not anymore.
Yeah, I would understand that opinion.
Maybe let's talk about Ledger X, because it sounds like we could do some smaller purchases there.
Let's do Bit.com or Deribit instead, because those are some of the platforms that I have more familiarity with. With Bit.com or Deribit, you can trade 1/10th of a Bitcoin or 1/10th of one contract. So one contract represents one Bitcoin. And the way that you can think of options, if you're new to options, you can think of them as insurance policies. So basically, if you want to insure Bitcoin at $50,000, you can buy a put option, and that would allow you to sell Bitcoin at $50,000 until your insurance policy or your option expires. And then you can buy insurance on the upside. So let's say you think that Bitcoin's going to go higher and you want to buy a call at $50,000. Well, that call will allow you the right, but not the obligation, to buy Bitcoin at $50,000 until the option expires. So if Bitcoin goes up to 100,000, then you have the right to buy at 50,000. That's sort of like your profit margin. And if Bitcoin drops, well, your option can expire worthless, and you're not on the hook to still buy it at 50,000. So that's kind of the basics of options.
Right. So all you would pay up front is the price of that option.
Correct. Yes.
The price of holding that contract, I guess.
Yep. Correct. The premium that you pay. Yep.
Okay. Let's talk about time delay. So there's an element of time in here, right? So in the future, let's say I expect Bitcoin to go to $100,000, but I don't necessarily know when. What's the optimal strategy to take with options if you think that this is going to happen, but you don't really know when? What kind of options contracts would you buy?
Yeah. So your first bias is sort of a long bias, and I would say it's a long delta bias, which you think the underlying is going to go up. And then your second bias is sort of like, I don't know when. So what I would do there is I would actually do sort of a covered call strategy. So if I own some Bitcoin, I can sell some calls against it. So basically, selling $100,000 call is probably too far out of the money. But what you could do is, like, you own some Bitcoin right now. It's at 52,000. Let's say you own one whole Bitcoin, and then you sell a call at 70,000. And so as Bitcoin goes up, that call goes against you. But at the same time, there's time decay to that call. So let's say you sell that call 30 days out. And so you just hope that it expires worthless while you get to sit on your Bitcoin. And if it doesn't, if Bitcoin just rallies and starts getting closer and closer to your call, then you can buy back that call that you're short and sell another one at 90,000. So that's like allowing you to roll your derivatives position up to so you don't get called out at 70,000 from your Bitcoin call. So the advantage there is that you have sort of a covered position, and you're getting paid income while you sit on your position.
How risky is that?
A covered call is not risky at all, really, because all you're risking is like theoretical profits on the underlying.
Help me walk the listeners through this a little bit more. So
Yes.
you want to do a covered call. What does that mean?
So the reason why they call it a covered call is because your short call is actually covered by the position, your underlying position. So in this case, the underlying represents the Bitcoin that you own, and then you're selling a call against it at some certain strike price. So let's call it 70,000. And then you just hold this position until either the position expires worthless or until the underlying sort of rallies to your strike.
My position is that I think Bitcoin will go to $70,000.
Mm-hmm.
And that's my underlying, and I'm selling calls to that.
Yep. And the call you're selling is basically promising to sell Bitcoin to the call buyer at 70,000.
How is that different from if I were just to not have an option and just do like a limit order sell at 70,000?
That's an awesome question. I like that. So the difference is you get paid for that limit order. So it's essentially like you're getting
Because you're
paid.
a maker.
It's not like a maker taker rebate. It's more like that call buyer is paying you to have that right. So you can almost think of it as like you're getting paid to put up a limit order. Because if you're gonna sell Bitcoin at that price anyways, might as well sell the call.
If you understand the options game, it is objectively better to do that than to just buy and sell and hold.
I don't know if it's objectively better. It's definitely, there's more moving parts and there's more nuance to it. I think it's better. I like it better, but I don't know if that's, if you're obsessed with options, it's objectively better. If you don't want to take the time to really learn about how options work, it might not really be worth the time to delve into.
How does somebody become obsessed with options? Like obviously you've gone down a path that led you to seeing options as awesome. And you know, what led you there?
So I'm not too sure why I think they're so interesting. But basically the steps of like a journey into the world of options. I think the first step is sort of understanding how the contracts work and what they represent. The next step is understanding like the Greeks. The Greeks are delta, gamma, theta, Vega, and rho, and sort of understanding how those affect the underlying price of options. And then the next step is understanding volatility and understanding how to trade options from a volatility perspective. And then the next step after that is understanding like the math behind price distributions. And then the next step after that is sort of understanding the spread in probabilities being priced from the volatilities of the implied volatilities in the options versus how the underlying price distributions would be. So like how does volatility react in 2017 versus how is volatility in 2018? How are the options being priced right now reflecting an environment that would be similar to 2017, so on and so forth?
Let's break all of those down. Hopefully we could just give a quick overview for each of those things. It sounds like a complicated game.
For sure. Yes.
What was the first one? The first building block, essentially.
Yeah, just understanding what options represent, like how do they work as an instrument.
And we did go over that. So
Yes.
let's move on to the next piece of building block, knowledge building block.
Perfect. So the first building block, the way I think about it is like what's the underlying right at expiration that the option gives you? And then the second block is the value before these options expired. And so before an option expires, the big name of the game with options is expected value, just like a casino is expected value at their blackjack table. So how is expected value or the value of the option, which is derived from expected value, affected by time going by? A change in the underlying, a change in the implied volatility, a change in interest rates. So those are the Greeks. So Greeks is delta, a change in the underlying. Gamma is like the second order derivative to delta. So how does delta change with a change in the underlying? And then gamma is the change in delta with a change in the price of the underlying. So let's say your delta is 10. So that means like your option is going to gain $10 when the underlying moves up $1. And then your gamma, let's say, is let's say is 1. So your first delta, like as the underlying moves up $1, your first delta will give you $10, and as it moves up another $1, it's going to give you $11. And so the reason why delta is not constant, if you want to just think of it like with an extreme example, if you think with an extreme example, let's say the underlying is at $100, and you have this option at 105 that expires in like 1 day. Well, as the price moves up towards 105, your option goes from like expiring almost worthless to almost reflecting the underlying. So like if it expired, let's say the underlying is at 104 and it expires, like your thing expires worthless, but let's say it goes up to 110, your option's worth $5. And so like the change in delta like quickly changes because your option's quickly going from out of the money to in the money near expiration, if that makes sense.
Would it be easier to demonstrate this from something visual? Is there something like a graph?
Just think of it as like the slope of the delta. So like that's basically what it is.
I see. Okay. So delta is a range.
Yeah, exactly. It ranges from 0 to 1.
Okay. And from 0 to 1, there's a slope.
Yeah, or you can think of it 0 to 100. Yeah.
And there's a line in between.
Mm-hmm. Yep, exactly.
Okay.
Exactly.
All right.
And so, yep, and gamma is a reflection of that change in delta. Theta is a lot less complicated. It's just a daily rate of time decay. So if your theta is negative 12, every day that goes by, you lose $12, or your option decays by $12. Now, theta also has sort of a slope, and you can think of it as like, as you grow older, like 1% of your, like when you go from 1 year old to 2 year old, like you've increased your life by 100%. 1 year represent 100%. When you go from like 99 to 100, 1 year represents a little over 1%. So just kind of like, that's how theta is as well. So theta increases at an increasing rate near expiration. Vega, that's if you hold all else constant, what is one change in implied vol due to the price of your option? And so that's actually the most interesting one, I think, is Vega, because everything is known inside of the option formula except for volatility. So options are not priced by the Black-Scholes formula or any other pricing formula. Options are priced in dollars by the market. And you can use that dollar value and plug that dollar value into something like a Black-Scholes formula and get the implied volatility spit back out. And what people do is that they look at the volatility that's being implied to the option versus the volatility of the underlying. And because options are one-way bets, meaning that if it goes in my favor, I win. If it goes out of my favor, I can't lose more than 0. So more volatility means an option is more valuable. And so the tools that we build are tools to analyze volatility. And then lastly, there's change in interest rates, which is basically some present value discounting cash flow stuff, and it affects like the forward price of the underlying. So forward price being like price of Bitcoin right now should theoretically be should earn at least a risk-free interest rate. And so that's sort of the forward price. And then the cash payment I'm going to get at the end of my option will be discounted back to present value. So those are kind of, row is like the most boring thing ever. I wouldn't even worry about it.
Okay. What is the Black-Scholes formula that you mentioned?
Yeah. Okay. So Black-Scholes formula is just a way to translate option dollar prices into volatility terms. And the reason why people want to do that is because if you're looking at, so options have all these different instruments that you can pick from, whether it's different strike prices, different expiration dates, so on and so forth. So it's hard to know what's more expensive. An option that costs $400 that, it's going to expire in 3 years and it's 10% of the money, or an option that's $200 that's going to expire in 2 months that's at the money. Like, that's very hard to compare. Yes, yeah. $400 is more expensive in dollar terms than $200, but it's not directly comparable. When you translate everything into volatility, you can see, okay, 99 volatility is higher than 90 volatility, and it normalizes for all those different variables. And you could say 99 is higher than 90, and therefore 99 is more expensive than 90.
Okay, if we take it back to the Bitcoin case, let's say people say that Bitcoin is volatile, right? How do you even ascribe a unit like 99 to volatility?
Yep. So the way, by convention, what people talk about is one standard deviation continuously compounded for 1 year. So basically, when you have a volatility of 99, you're saying that one standard deviation is 99% continuously compounded.
How do you measure one standard deviation change?
Great.
Is that like a dollar change in Bitcoin, or what does that mean?
So that standard deviation would be in percentage changes. So the way that, so there's a couple ways of doing
from time. Yeah, from when?
Yep. So you can do it. You can do any time period. You just got to adjust back for the time period on the way out. But basically, I can look at month to month. So where did the month close? Where did it close next month? This is the return, and then I do the log normal of those returns to get like a continuously compounded return. And then once I have that, basically I can do times the square root of 12. So that gives me like a 1 month. So the reason why it's the square root of 12 is because standard deviation is the square root of variance. And so you got to do by the square root of time, and then you can annualize it like that. If you're looking at 1 minute candles, you can do that with 1 minute. And I think it's times the square root of like 525,600, something like that. And so that's how many minutes there are in a year. And basically that's how you would do it.
Okay. All right. So again, for something like Bitcoin, what's the current volatility?
Yeah. So actually, let me share.
Is that what a VIX is?
Pretty close. You could basically say it like that. There's one little nuance with VIX that it looks at the whole strip of options for continuous 30 days. But basically, you could say that's the VIX. So basically, what we're looking at here right now, here's what we call the term structure. So this is showing us the implied volatility of at-the-money options for all the different expirations. So we can see right now the most expensive vol is for the options expiring on March 26th, and those are implying 111% Bitcoin volatility.
You've mentioned in the money and out of the money. Can you just define those terms?
Yes, great question. So when you're picking out an option, you pick out a strike price. So a strike price is where does your option kick in? And so if right now Bitcoin's at 50,000 and you're trading a call is betting that the option goes up, that the underlying goes up. If you're buying a call that's at 48,000, well, 50,000 is already in the money by $2,000 because it's already $2,000 over the 48,000 strike price. At the money is like an option that's exactly at 50,000 when the underlying is exactly at 50,000. And then out of the money is something like 60,000 when the underlying is 50,000.
I want to take it back to the Wall Street Bets case very quickly.
Yes.
Okay, so what happened with GME was all of those hedge funds, they had shorts, right? And so
yes.
Does that mean they all just had a bunch of put options and they got liquidated?
So in this case, they were short the underlying. So they were short the stock. So if they were short puts, wouldn't even matter if puts rallied, if the underlying really rallied a lot, because that would be no different than like it just sitting there and puts expiring worthless.
Going back to this in the money.
Yeah. So basically, here's what we're looking at Bitcoin volatility right now. So we can see that options that are expiring on the 26th of March are the most expensive. Those are implying that Bitcoin, one standard deviation of Bitcoin prices is up 111% continuously compounded, which is really like 300%, or down 111% continuously compounded, which is really like down 65%, call it.
Let's break that down. What does that mean when you say that? Continuous compounded, which is really 300%. You continuously compound 111%, and that really means 300% volatility.
That really means that 300% increase in like the underlying. So it's really like E to the 1.1, and then or E to the negative 1.1, and then I can't do that math off the top of my head. I got a calculator here somewhere. And if I was going to plug this into my calculator, like E to the 1.1 is 303%, and E to the negative 1.1 is negative 67%. Convert to decimal for the actual calculation, which the actual value of E to the negative 1.1 is 0.33, which represents a loss of 67% in absolute terms. And so the reason why people look at it like that is because prices are bounded by zero and prices are bounded by infinity on the upside. So using continuously compounded returns adjust for 0 being the lower bound. So basically, what I'd be looking at here is like if I want to sell volatility, I know where on the curve is the most expensive, and I would probably want to sell this March volatility. If I want to buy volatility, if I have a short-term bias and I want to buy volatility, I'm probably looking at these options that expire in a few days that are trading 96 volatility or 102 volatility. And then if I have like a very long-term opinion, I could do something where I could buy one option and sell one option. So let's say I want to buy this December 2021 option. I could pay whatever this value is, 93.5. And I could also finance that option by selling a June one that's trading at 99 volatility. So I'm combining options to buy relatively low volatility and sell relatively high volatility. So it helps you to kind of spread options together.
Yeah, and this is typically the case when you're trading options, right?
Yeah, you can make directional bets with sort of one-off options, which I think is a lot of like the kind of the Wall Street bets crowd. Like they'll buy like a bunch of calls or buy a bunch of puts. Those are really kind of leveraged bets on the underlying. And yes, volatility is a component of that, but it's sort of like a secondary or third component. But when you're trading volatility, what you do is you combine many options together to isolate the volatility element. And you also like can trade the underlying itself to call it delta neutral. So if my option has like a delta of 10, I can sell 10 shares to sort of like neutralize the move in the underlying and just capture the magnitude of the move in the underlying.
Can you take us to a DeFi protocol that you like? Can you do like a quick live demo of?
Sure.
Yeah, of some DeFi options trading.
So here is Open. So Open basically has some DeFi Ethereum options. And so there's some expirations I can pick from right here. So let's go to this March 26th. Open tries to line it up with the CeFi world.
Why are these dates selected in this way?
Yeah, so Open tries to really be close to the CeFi world. And what's nice about that is you can sort of price your options in a very similar fashion. And it allows people to sort of arbitrage any sort of deviations between the two. So basically, I could go to March 26th, and let's say I have some Ether. Let's say I own some Ether. I can sell this covered call. Let's say I want to sell. Let's say I want to sell this 2,240 call. So I'm promising to sell my Ether at 2,240 if we get that high, and then someone's going to pay me $242 today to do that. And so basically that's a vol of 145. And so what's cool there is that I still have some upside in my ETH. I can ride it up all the way to 2240, and I get paid $242 today for that, for giving up the rights to profits above that strike price. And so I sort of hedge my position in case Ether falls. I get to keep that premium. And in case Ether rallies, yes, I've given away some upside, but I collected some upside right away as well. Mm-hmm. On the reverse position is basically you can buy these calls at 242, and basically your break-even price is going to be 2480. So if Ether gets above 2480, not only do you recoup the premium you paid for your call, but you sort of get all the unlimited theoretical profits above 2480. And so the way that this works is basically weak USDC. Use your MetaMask account, and you can basically execute these on chain. And there's like some decent size. So like right here, there's like you could buy up to 75 contracts, and you could sell up to 170 contracts. So that's some pretty decent size for sort of an online on-chain protocol. I mean,
well, what's in each contract?
So each contract is collateralized by a full token. So the person who's selling the call has essentially locked up a full ETH into that call. And then at expiration, it's cash settled, but just to keep it simple, at expiration, you basically could swap out USDC of 2240 and unlock that ETH. That's like a physically settled. Now it's cash settled. So the way that they do it is basically they'll pay out in USDC the theoretical profits.
I'm a little slow on the uptake here. So
I know,
okay,
it's like so many moving parts. I know for sure.
There's a lot going on right here. So so these are the strike prices, right? So and we have these four options at the lower columns, and So this means that at the topmost one, the strike price is 1,600.
Mm-hmm.
And that means somebody thinks that ETH is going to go to 16. What's happening here?
1,600 strike price means that this option, that if you wanted to own it, costs you $571, would give you all the upside to ETH above 1,600. Or, in other words, allow you to buy ETH no matter how high it went for $1,600 per ETH.
All right. And so, sorry, and this price, $571, that's the cost of one contract.
Correct. Yes, exactly. And then over here, this is telling you to break even. So if you buy this contract, to break even on this contract, ETH has to be at least 2171, which is basically 571 plus 1,600. And then here, the size is saying that there's 23 being offered. So you can buy up to 23 contracts. And there's 123 contracts that you could sell into.
If you were to look at this and analyze these options right now, which one is actually attractive to go into, if any?
Yeah, so awesome question. So this is a very high volatility environment. So let me go back to this butterfly real quick. So butterfly position, I buy one of these 2240s. I pay $242 for it. I sell two of these 2880s. I get paid basically 113 times 2, 226. So now I'm pretty much in for $26. And then, or yeah, 26.
So $26 is the difference?
Yep. Yep. $26 is basically the difference of these. $16 is basically the difference of this position. And then lastly, I buy this 3520 contract for $58.
Sorry. $16 is the difference in a butterfly position between 2240 and 2880.
Okay, so I paid $242 for this. And then I sold two of these for $113 each.
Okay,
so
got it. So
paid me $226.
226, 242 minus 226.
Yep, it's
that's
the $16. Yep, that's the difference. So far I've paid $16 for this position. And then lastly, I buy this 3520 just in case ETH goes up all the way to 10,000. I don't want to be like naked short an extra option. So I cover my risk by paying $58. So now I'm in this position for basically $74. And then I can...
Sorry. How does this work? So let's say ETH gets to what? $3,000? Or what was the number you threw out?
Yeah. So that I'm basically covering my risk in case ETH gets higher than 3520.
Okay.
So basically
so that you will still have ETH as an underlying asset.
Or more so I don't lose my shirt, because basically I'm buying one of these, but I'm selling two of these. So there's one that's kind of open-ended risk. So I want to buy another one here to sort of close off that open-ended risk.
Got it.
So I bought two and I sold two.
Okay.
And then my sweet spot is really this 2880. So my max profit is at 2880. And then my max loss is going to be at 3520. And that's sort of lots of moving parts for sure. But that's like sort of like a butterfly. And the reason why those are interesting is because right here, we're in a high volatility environment. So for example, just kind of for perspective, ETH over summer before the rally sort of started, like the volatility was in the 50s. And right now the volatility is like 150. So I don't want to just go out and buy an option that expires in like a month and pay $242. ETH needs to move a lot for me to make my money back. But if I buy some options and sell some options against it, I can sort of like only lay out $60 or whatever I said, $74, and now get some exposure. And I've sort of like neutralized the aspect of paying a high implied volatility. And so that's why combining options together really kind of helps you avoid like different volatility environments.
Let's say you went with this butterfly strategy and ETH went to like $5,000. At the end of that, what do you make? What did you just make?
In that case, you would lose. So I would make in this case, I would make 640 on the way up. So I made 640 is the difference between 2240 and 2880. And then basically 3520 minus 2880, 640 again. So that's pretty much the one that I just made. So the max I can lose is $74. That's the maximum. So that's my max loss. But my max profit, if we expire exactly at 28.80, my max profit is $640. And so you see, I sort of have like this window of profitability. And if we like move too far too fast, I'm cool. I'm hedged out. And if we don't move at all, I still didn't outlay that much money. And so you could buy like 1,000 of these, and it kind of becomes interesting.
In this case, if ETH went down, let's say it went down to like 1,200, where would you be?
I lost that $74 that I paid for the position.
Okay. So, all right, where's the sweet spot?
Sweet spot, I start making money above 22.40, and my max profit ends at 28.80. And so anything between 22.40 and 35.20 is going to be making money.
Okay. All right. Well, that's a decent range.
Yeah, exactly. It's a pretty large range. And so you haven't really put up that much money to get that exposure.
And just to circle back again, comparing it to what you would have otherwise gotten with just a straight limit order or just holding and doing a limit sell.
Yeah, in this case, it's not directly an analogy, but let's go back to the covered call real quick. So let's say you did the covered call, right? And you sold you have a limit order to sell ETH at 22.40. Well, if you're selling the call at 22.40, you're going to get an extra $241. Now, the downside, the main difference between the limit order and selling the call, the limit order, you can change your mind and cancel your limit order, and there's no cost to that. The call, if you short the call and you sold it for $242, and we rally all the way up, another $300, and you want to change your mind, you're going to have to buy that call back, and it's going to be a lot more expensive. It's probably going to be, if we rallied like, whatever, another $600, that 242, it's probably 567, if that makes sense.
So you can't actually buy your contract back at cost. You'd have to buy it back at a different option. You
have to buy it back at whatever the market value is. Yeah.
Got it.
Yeah, exactly. Okay. So that's the downside.
How is market value of options determined?
So it's purely supply and demand, but kind of jumping back to those Greeks sort of determine all the factors. So every day that goes by, this decays a little bit. This option will decay a little bit. And then if the underlying gets closer to it, this option will gain value. If the underlying moves away from it, it's going to lose value. If the implied volatility, this 145 changes, if it goes down, this option is going to lose value. If it goes up, this option is going to gain value. And so all these sort of like these Greeks show the change in the option price by isolating for a different variable. And so it might be the case that if enough time went by and Ether rallied $300, you could still buy this for cheaper than what you sold it for. It depends on how much time went by. It sort of also depends on what volatility did. Real quick, just one last thing. Like in this environment, selling 145 volatility is pretty high. So like 145 volatility, let me just check this out real quick. So 145 divided by square root of 365. So right now, this assumes that one standard deviation is a $7 move, 7.5% move in Ether. ETH is right now 1950. So like they're saying like one standard deviation is a $150 move up or $150 move down. So that's like a lot of movement in ETH that's being implied into the option right now. So that's pretty high. So like if you're going to sell some volatility, now is probably a great time to sell volatility. If you're selling covered calls, now is a great time to sell covered calls.
Right now in particular, there's a lot of volatility. And so
ton of volatility, yes.
All right. And when there is a lot of volatility, best bring out the surfboard and ride the waves.
So to speak, yeah.
And objectively speaking, Bitcoin and Ethereum, as well as other altcoins, are high volatile assets from an options perspective, where there's a ton of spread that you could make money in.
Yeah, and they're also like very inefficient. So here's something I always like to tell people. So sometimes I have people ask me like, should I trade stocks or should I trade crypto? Here's the difference between trading stocks and crypto. There's some guy who's like 80 years old right now who has 70 years experience trading stocks in the market. or trading copper or trading platinum or gold.
And he will beat you every time.
It's just got more experience.
Yes.
No one has that much experience in crypto. No
That's
one.
right.
Period. That's just not a thing. And most of it, and probably the first 5 years are dominated by devs. So like if you're someone with a kind of finance background and you already kind of understand a lot of these financial concepts, and now you're stepping into the crypto options world, there's not a lot of people with a ton of experience in the crypto options world. And not only that, but like crypto is a new like paradigm shifting asset class. Like no one can even tell you what crypto should be worth. So no one can definitely tell you what like volatility curves should look like on Bitcoin or Ether or any other like sort of altcoin. So it's like, it's really anyone's game to discover right now. And it's an even playing field. So
yeah, that's amazing.
That's why, yeah, it's amazing. That's why it's really the most interesting thing. Yeah. And from my perspective, as someone who really likes options and derivatives, working with this sort of data set, I think is very interesting because like you're analyzing this data that not many people have been analyzing. No one's been really analyzing before you. So there's a lot of edge to be had.
Yeah, absolutely. And that's why I'm glad you're on here because you're actually kind of a unicorn in the space. Because cool. Right, you're somebody who has a technical analysis background, somebody who has a finance background, operating in this really new crypto space, who also understands crypto fundamentals to a degree, not to the extent that like a protocol engineer would, but what does that matter? And there you go, you have the advantage, right? I get the question all the time from people in like, a small trading group that I host, and they also want to know whether or not they should enter into stocks versus crypto. And yeah, and to me, crypto is like, I really understand it from the protocol perspective, right? And what's going on there, as well as the teams. And so each of these are money games. There's the stock game, and then there's the crypto game.
Yeah.
So in the stock game, again, yeah, you're right. People with 78 years experience is going to just outplay you every single time.
Exactly.
You're trying to, yeah, we're trying, you would otherwise try to enter into a money game where there's just people who like Munger, for example, Berkshire Hathaway.
Yeah.
These people are going to just like railroad you.
Yeah, totally. I really like the sort of like the chain of ownership. So like if you think about the traditional markets, it's like there's a startup company that VCs invested in. And then after VCs, there's sort of like Series A and all those other VCs. And then finally there's like it goes public. And so like it's always like these very like close loops of like professional investors who sort of like get in early, and then it's like the next set of professional investors and so on and so forth. And then finally the retail public is the end, buying like the final bags. Okay. Well, in crypto is 100% the inverse.
Yeah.
It's like all retail people who were able to buy and who were like, had the foresight to get in and were like nimble enough that they didn't have like all these fiduciary responsibilities that said you can't invest in internet money. So like it's all them. And then like VCs started getting interested. Well, then ICOs happened and VCs started getting interested. And now we finally have like public companies starting to buy. And then we'll see when like some central bank decides to buy some, or FX reserves, whatever it is. But it's the inverse chain. Retail is the first one in the game here.
Yeah.
And so again, another reason to this is the arena to play in. Right.
Absolutely. You've got asymmetric advantage as a retail user. Anybody who is an early adopter of crypto, and it's just following the space, right? Because you're interested in it. Yeah.
Yeah. Exactly.
Excellent. And this is exactly what this channel is catered towards. It's the retail users, anybody who's been priced out of IPOs. If you're not an accredited investor, usually you would have been priced out, right? But in crypto, it's just anyone's game.
Yeah, exactly. Accredited investors are now buying for the very first time at $50,000 Bitcoin.
That's right. That's right. Meanwhile, all our friends, anyways. I was going to say, people who knew about this from years ago got it for cheap, and and now there's all these new crypto tokens as well that are also on the cheap. But as soon as institutions arrive, they'll be late in the game.
Exactly, and if you feel like you sort of missed out on crypto or the crypto rally, well, there's probably going to be a bear market at some point. So that's something to look forward to for you guys if you haven't bought in yet. But then also like start a project, like start doing some code in the space, start developing your own project, launch your own token. I know there's like some jurisdiction stuff for that, but maybe incorporate or move to a country that's friendly towards those sort of jurisdictions. And there's like nothing stopping you from becoming a creator in the space. And that's probably more lucrative, if anything.
Yeah, it's totally permissionless, and that's
amazing.
Yeah,
yeah.
Permissionlessness is inclusivity. Anybody can do.
Yeah, totally. Totally.
Kind of, if you can code.
Yeah, and if you can't right now, you can learn though.
Yeah, totally. Well, awesome. So, let's close out on your macro view, right? You said that you expect a bear market to come back, right? Because these are market cycles. Everything goes bear and everything goes bull again. So Let's talk about that. Like right now, we are like smack in the middle of a bull market. Where do you think this is going in the like next 12 months?
That's a hard call to make. I don't see anything saying that this bull market is over right now. I don't see anything to lead. The only thing that makes me think there could be a pullback is just because we've gone up so far so fast. But that's just like a recency bias. That's just because I remember prices being cheap like 6 months ago. That's not like objectively speaking. There's nothing in the market saying that this is over right now. There's nothing.
Okay, so it's just your intuition, or
I'm not even making that call. I'm just saying at some point there will be a bear market. There's no way that there isn't one, but I don't see one on the horizon right now.
Yeah.
Now I do think like there's probably like going to be like some flash crashes and stuff like that, just because it's a volatile asset class that there's going to be dips and stuff like that. But as far as the trend being broken, I don't think it's broken right now, and I wouldn't start betting on it being broken. Mm-hmm. But I think you could play it in smart ways.
Is there a point in which you see the bubble can burst?
It's weird. It's such a weird time right now. It's hard to say.
Okay.
The fundamental value of having an asset class that allows you to have perfect portability. I mean, that's a game changer. That's such a game changer. So and it's a global asset. I don't know. So I think those kind of two fundamental utilities are very important. And then I also think
you're saying portability in that it's really easily transportable.
Yeah, exactly.
Yeah, USB stick basically.
Yeah, if that even. Yeah,
right.
Just memorize your mnemonic or however you say that word.
Mnemonic. A sea anemone.
Exactly.
Yeah.
And then we have sort of the COVID response, like the global liquidity injection from the COVID response. I don't know where that ends or how that stops. Or
the COVID pandemic. I mean, this run up is definitely, it's the silver lining to that, right? Anybody who kind of saw this crisis coming. Not that anyone could have seen COVID coming. I'm saying anyone who saw a potential currency crisis coming, bet big and won big, betting on Bitcoin and cryptocurrencies. This was the reward. I guess this is really rewarding, right? To have that conviction validated.
Mm-hmm, mm-hmm. Yeah, definitely. I mean, even the GameStop thing is such a great example. You now have this new financial infrastructure being built on Ethereum. And probably some other chains, in the short run. That's very decentralized and permissionless and kind of true to not being the rules changed on you because a few individual players want the rules changed. I mean, what a great ad for decentralized finance. Yeah.
There is still a bit of that rules changing and rug pulling in crypto, but not so egregious and unilateral as in the traditional markets, as we've seen. Mm-hmm. Yeah, so that's great.
Crazy stuff for sure. There's some weird edges, but yeah, I agree.
Something like what happened in the Wall Street bets phenomenon with Robinhood and Citadel and all of these hedge funds basically unilaterally pulling the wool over your eyes and pulling the rug out from underneath you is so looked down upon and taboo in crypto that it could never happen. Something like that happened to a crypto project, it would be dead. I mean, it would lose all reputation and nobody would trade on it anymore.
Yeah, I mean, there was the big like Ethereum Classic Ether hard fork back in the day, and that was a big question. You know, should the hacker, you know, be allowed to like exploit the code and run off with everyone's funds?
Yeah,
to me, that's like, you know, breaking someone's code and stealing all their funds is not quite the same thing as like changing the rules for short sell, or like going into people's account and selling their long positions so short sellers can like recoup their losses. Like one is very glaringly obvious and the other one's just kind of a hard read. And even the hard read in the Ethereum community was, you know, vastly debated, like greatly debated. So
to people who aren't familiar, we are talking about the 2015 Dow hack, right? Was that 2015?
I think so, yeah.
Yeah. The DAO was a smart contract on Ethereum, and the software was exploited by a hacker in a way that was completely allowed in the program. And so because of that, Ethereum had split between a project called now Ethereum Classic, ETC, and ETH. And so what happened with Robinhood and NASDAQ and the broker stopping trades would have been akin to the miners mining the Ethereum blockchain, colluding with Vitalik Buterin and shutting down trades. Thank you so much, Greg, for being here. This was highly educational. People listening on this channel would definitely get a lot of value out of it. Yeah, we'd love to have you back at some point. You know, this is totally a trading channel. We want to learn more and more and dive deeper into the world of options. So you're the guy.
Love it. Thank you so much. And real quick, just if you guys ever want to check out the website, we have a free tier of analytics. That's gvol.io. You can follow us on Twitter, @GenesisVol. And if you read our weekly crypto volatility newsletter, which is genesisvolatility.substack.com.
And I'll have all of those links linked down below.
Awesome. Thank you.
All right. Thanks, Greg.